Good morning, everybody. The Nifty quite a disappointing close for the index last week. It managed a bounce back. It went all the way towards that 5K mark on the upside. However, with Friday's sell-off, it was close to a 2% negative weekly close in terms of points. The index lost close to 94 points last week. So far, this is the weekly chart of Nifty Future, and so far we have seen that over last 3 weeks, our expected supports of 4740, 4780 held well, which led to the short-term bounce back. This is the daily chart of the same index, which shows that a bounce back did come through, which took us all the way close to the high of 5011 on the upside. However, then it completely failed. It fell below the trend reversal level of 4950, and with the Friday's sharp sell-off of 91 points, we are back to a downtrend across all time frames. Obviously, the support to keep watch for right now is the erstwhile support range, our 40-point range of 4740, 4780. But keeping in mind that we are going to open with weak global cues, a test of these supports are very likely and possibly a break below that also. In that case, the next psychological level that comes into the picture is close to the Jan lows, from where we had the nice trend up, which is close to that 4600 mark, and for the Sensex the respective level is close to 15,500. We do have a rising gap on the Nifty Future. Gaps generally act as a good source of support, and that gap is close to that 5660, 5680 range. So one can look, one can see that if the selling persists and a break below 4650 towards 4600, I think that's the kind of support that the market will try to hold, if and only if 4740 is given away. A look at the sectoral indices, and we see that over last 1 week, it was the IT and the tech stocks which did relatively well, thanks to for the IT stocks, thanks to the still depreciating rupee which is there. However, within the losers, it's the cap good. The erstwhile consumer durable stocks are also now have sold off quite sharply last week. Auto, banking, and oil and gas are the ones which were amongst the top losers in last week's trade. Last week's trade also marked the end of the month, and the second column, this one shows the monthly performance of the BSE sectors. As we can see that the cap goods, power and auto top the list of losers as well. IT is there surprisingly because of the large cap Infosys stock, which fell quite sharply. Amongst the relatively ones which did fairly well, it's the FMCG, which is still holding well, along with healthcare, which was down just 1.33% last month. Going forward, we sense that the healthcare will be on the verge of some selling pressure, as we notice some amount of selling coming in. Stocks like Dr. Reddy, Sun Pharma are at make or break levels right now. The FMCG will continue to hold well, and within the weaker ones, I think the rate sensitive sectors like the auto and the banking, which have seen this selling in the current sell-off of the markets, will continue to see further selling. Within the banking stocks, the likes of an SSBI or an HDFC Bank, which has given a fresh breakdown, are the ones which can correct further down from current prices. One look at outside our markets. We just did a scan across different days performance for the emerging markets as well as the developed markets. Now this is where we stand, and this table is sorted in terms of the last 60 days, and we see that we are midway of all the emerging markets. So Russian markets are down 26%, and the other end of the spectrum, the Mexico, Shanghai and the other markets are down little close to that 2 to 3% range. We are doing relatively okay because the emerging markets are down close to 10% over last 60 days, and we are down just 7%. However, one key thing that throws out from this table is Shanghai market. Shanghai Composite is one market which has posted positive close over last 5 days is 1 week, and close to last 40 days. So this is one index which is gaining some strength within the emerging markets. It's a gloomier picture within the developed markets. Over last 60 days, on an average, the indices have lost close to 12%. European markets, obviously like the likes of Greece, Spain, Austria, the ones which have corrected the most. Dow Jones Industrial relatively better off within the losers, but still down 5.6% over last 60 days. If you look at the 20-day figure, that is close to a month, the index is down close to 8%. Our Sensex is down close to 5% over last 1 month. So relatively we are doing better than the overall world markets and relatively better than our emerging markets as well. But this stay table is clearly shows that equity as an asset class is still in a weak trend, and once you look into the charts of these countries, they are still in a downtrend. Short-term supports hold for a bounce back, but they don't last. So I sense that for a quarter from here on, equity will be not in favor, so as to say, and money might come out from this market. However, especially our markets, Nifty does manage to give good swing ups. The bounce back do tend to range in the range of 8 to 10%. So it's more of a trader's market now, and for a quarter we should maintain that view. This is not the best of times to build a long only portfolio. On the other hand, one can look to trade on both the sides with a time frame of like a 2 weeks and a percentage wise 8 to 10%. Net the view is still weak. The index has gone down to a downtrend across all time frames. Waits to see whether 4740 holds or not. A failure of that, and probably we are back to that 4600 level for the Nifty future. You have a good week. Trade well. Thank you.